Well, welcome back, everybody, to the Four-Star Wealth Financial Advisors Workshop. And today we've got a really interesting gentleman to talk with. His name is Gil Baumgarten, and Gil has his own firm. He's in Houston, Texas. And when you hear what he has to say, I think you'll be really impressed and you learn a lot of things about the industry. So, Gil, welcome to the Financial Advisors Workshop.
Thanks for having me.
Excellent. Well, thank you. And you're in Houston today, right?
I am, yeah.
Okay, great. Well, when we put out the clarion call for certain advisors to come on, and Gil stepped in to talk to us, we really realized what an incredible guy you are and what you've built in the business. And Gil, maybe you could tell our listeners how you have a $1.3 billion firm now, which is very impressive.
Thank you.
So let's talk about how you started to get where you are today. You were with wirehouses, and I think we're about the same age, and you got into the industry around the same time I did back in the 80s, right?
Mid 80s, yeah.
Okay.
Yep.
So what was that like for you?
Well, I've always been good at math. I'm a little bit introverted, so I'm not the gregarious guy who you typically see as being successful in the brokerage business. I'm very introspective and tend to want to know how everything works. And maybe I've done okay with attracting new business, not so much because I'm so outgoing and charming, but maybe because I understand how things work and can communicate how they work to help people make better decisions. So it's more of a guiding type of philosophy. I guide people along and sort of point out the pitfalls to them, and because I don't have any agenda to try to sell any particular product, it tends to work well with just getting paid to help people navigate the system. So that's essentially how I got started. Went to work for E.F. Hutton in 1984. Stayed through the Smith Barney days. I left in February of 2000. Moved to Payne Weber. Payne Weber instantly got bought by UBS. I tell people I did 10 years of hard time at UBS because I wasn't particularly fond of it, but I had a partner that I couldn't leave. He was sick, and so I stayed for a decade. And then when he retired, I started an RIA and took a couple of $100 million from my former UBS days.
Nice. So was that most of your book, or did you leave some of it there when you left?
I left the transactional part of the book behind. When I merged my business with my partner, he was an old style stockbroker, and I was more of a discretionary portfolio manager doing a wealth management type of business. I've never done financial planning. I've done more wealth planning, and I've always focused on the larger client. I used to have $1 million minimum when I was at UBS, and now it's more like 3 or 5 million. And so that's our client base. And anyhow, that's how I got started.
So you mentioned wealth planning versus financial planning. Financial planning would be eMoney, would be Money Guide Pro. What do you consider wealth planning?
I make a distinction in that financial planning is for the client who still fears running out of money. And it's all about budgeting. And if I take these steps and I take these number of steps at this size over this period of time, then here's what I'm liable to have in the end. Once you end up with, $5, 10, $15 million, you sort of shift your perspective about it. You're not liable to run out of money, and it becomes more about risk and liquidity planning and charitable giving and optimization of intergenerational wealth transfer. Those types of things are more wealth planning, and I don't consider them to be financial planning practices.
Right. And you probably did some financial planning with some of those folks years ago, but they've grown up and now they're very wealthy, and kind of cash flow analysis isn't as important.
That's exactly right. Yeah.
Yeah. So Gil, that would lead me to believe that of your 1.3 billion, most of your clients are the ultra high net worth variety.
Yes.
10 million or more. Do you have any that are less than that?
Yes. Although we don't really want to encourage any more of those, we still have the ones that have been loyal to us and have been clients for decades. And so I have clients on my books from 30 years ago that are still $1 million clients. And although I wouldn't necessarily try to bring them on as a new client. I'm happy to service them, give them advice, and guide them through the remainder of their lifetime. So I have a moral obligation to those people, despite the fact that it's not probably optimal for my business model.
Right. But that's great that you continue to do it, and it's the commitment in our industry that the good professionals do. So that's great. That's great, Gil. So you had told me earlier when we were discussing before we started taping our discussion today that you then, after you left UBS, you wrote a book.
I did.
So let's talk about your book.
So the name of the book is Foolish, and the subtitle is How Investors Get Worked Up and Worked Over by the System. And when I first started creating sort of the outline of the book, it was originally going to be about, well, let me tell you how an annuity works. Let me tell you how a mutual fund works. And it kind of evolved into something other than that, which was not intentional. And the book sort of evolved into an expose on the broker-dealer world and the dark corners that operate inside of the ecosystem that I've always felt like jeopardized the trust relationship between the broker advisor and the client because of the agenda of the broker-dealer world and the way they cross-pollinate all types of their business and make layer upon layer of undisclosed fee, many of which the brokers do not understand, and clearly the clients do not understand. And so I always perceived that I had a lot of return decay in the products that were pushed by my broker-dealer. And I gradually came to realize that much of that was just from too many hands in too many pockets, and just the manufacture of products that really don't have much odds of creating an optimal outcome for the client. But nonetheless, the broker-dealer world makes a lot of money on it. I had a situation that is actually I wrote about in the book where I went to a meeting where the product people get up and describe this new unit trust that they're going to create that has a 4% commission in it. And it's essentially an index fund at its core. So they were going to take the S&P 500 and they were going to delete the 50 names that they didn't like. And that was going to be where the alpha was going to come from. And there's no way in a 8 to 9% return world, which is what the S&P generates over long time periods, that you can take 50% of that return in the form of a fee and expect anything except a subpar outcome. Not to mention that the vehicle liquidated itself at the end of a year, causing the client to have a taxable event that would further erode returns. And then the client had to buy another product later that would have another fee attached to it. So I complained to my boss about it. And he told me that 2 out of 3 winning in that equation wasn't bad, that the broker made money, the firm made money, and 2 out of 3 wasn't bad. And so I thought, well, it really kind of drove home for me what the system really was underneath. And I found that very unpalatable. And the bigger my book of business got, the more important it was for me to control that.
Yeah, we talked about that earlier too. That what wasn't it? Elliot. I forget his last name. The Attorney General of New York. Didn't they clean up the brokerage industry?
Elliot Spitzer. Yeah.
I'm not sure they did. Right. I think there's still plenty of abuses in the broker side, and
well, a lot of it is just political grandstanding. They want to shake their finger at people and come up with these new rules. And some of the things that they come up with, like the Reg BI, regulation best interest, is still just a disclosure document in the end. It does not change the standard of care of being suitability in the end. And so to even have the name of regulation best interest is a total misnomer. And so it's just a lot of political grandstanding as far as I'm concerned.
So they really do need to still clean up that side of the business. But you've gone completely to the RA side where we are, and I'm with you there. Where we are actually obligated to the best interest of the client. And so we're really doing that, right?
Well, I kind of look at it a little differently. And I'm not so sure that cleaning up of the industry is required. I can see a lot of situations where a stock brokerage firm with a stockbroker employee could provide the most optimal outcome for a client, clients that I would never be able to service. And even if my clientele were smaller down the ecosystem, I still would not be able to take on fiduciary responsibility. And the example I give in my book is what happens if, you know, Uncle Tom dies and leaves his $300,000 to three heirs, and those three heirs have no idea what to do with their $100,000. There is no way anybody in the fiduciary world, I don't care how far down the economic curve you are, there's no way it makes any sense for a person in my industry to spend any time dealing with those three $100,000 heirs, where they could go into a brokerage firm and get some advice about a couple of transactions and sell a few things and buy them a mutual fund with a load in it. They're going to do way better in that than they would being out on their own. And regulating that into oblivion does not serve the community at large. People have plenty of choices to go up market into the RIA world if they want that advice, and they can go down market into the brokerage world if that's where they want. Do not think it is wise to restrict the choices of those people by making all advisors adhere to a fiduciary standard. There are plenty of fiduciary advisors out there for those people.
Yes. No, that's interesting. And so there is a place for the broker world, but then a lot of the issues, overcharging of fees, hidden fees, and all those things. Those things still probably need to be cleaned up. But there's a role for them. There's a role for them. And
I
think you're
agree.
right.
I agree.
Yeah. So tell us what else was in the book.
Well, I talk about, the first third of the book is kind of an expose on the broker-dealer world and giving people some idea of what that ecosystem looks like so they can navigate it better. And then the back 2/3 of the book is just about the uphill battle that investors have trying to learn their way through that system and learn about themselves, what it is that motivates them. A lot of people are motivated by the ability to brag about how well they've done. A lot of people operate, and I think this is one of the critical elements of the book. People operate from a scarcity versus an abundance mentality with regard to how much comfort they have regarding their own economic scars that have occurred to them over their lifetime. And they carry mental baggage into the decision making process that pollutes the system that would generate the most optimal outcome for them. People carry mental baggage about things they've lost money in before, and they try to avoid that, where if they would just have adapted their mentality towards it a little differently, they would have been willing to take that risk. We find that people who get scarred by a market crash when they're 25 years old and have really no money to be taking the risk and no money to actually lose when the stock market falls apart, those people develop bad habits with regard to how much risk they're willing to put in their portfolio, because in the end, the rich get richer because they're willing to take risks. And that's what separates the wheat from the chaff. And people at the lower end of the economic spectrum could learn a lot about what to do. A lot of that comes with having an abundance mentality, that even if you've only got $10,000, you still can meet your bills. You still can, go out with your friends. You can still do things, but you just have to be smart about it. And that risk taking would allow them to build up enough momentum that would carry them through their prime investing years and have much better outcomes for people. The other thing we talk about in the book is the effect of fees and taxes, and the fact that fees and taxes are controllable, whereas the incremental return from fancy investing methodologies is not controllable, is not repeatable, and more than likely will lead to disappointment, where if people had focused on the controllable, controlling the controllable is much more important than pursuing the unknown. But pursuing the unknown is a much sexier sphere to be operating in, and people get drawn into that. So we explore all of those, tentacles of the octopus, if you will.
Interesting. So it's really a service for the investor, and kind of an expose of what's going on in the industry and how not to get caught up in it.
That's exactly right.
Which is great.
Yeah.
Well, good. And your book is still available.
It made Amazon bestseller status. It's on Amazon. It's available on Audible as well, and it's on the Target website. And So it's even in the Harvard bookstore. I couldn't believe that. So
Nice.
anyway, so those people can find it in all kinds of places. So Foolish is the name of it. It's a yellow cover with a ladder on the front of it, a guy climbing up the ladder. So anyhow.
Nice. Well, I think we all should pick up a copy and have a look.
Yeah.
Well, good. Well, then after you left UBS, you took 200 million or so, and your partner had left, and so now you got to run the practice on your own. But
Yep.
now you build it to a 1.3 billion, and you got an ultra high net worth practice. How
Yep.
did that happen? How did you get there? And how do you think that worked with an independent firm? Some people would think you got to be at Morgan Stanley to have that kind of an asset base.
I would say that my book of business got big because I was an RIA, not despite the fact that I was an RIA. I found people were much more willing to write much bigger checks when I talked to them about the fiduciary standard of care as opposed to the suitability standard. And a lot of it has to do with my unwillingness to accept smaller clients. When I was first getting started in the business, my gosh, $1 million client was gigantic.
Yes.
And over the years, it's not that much money. Part of that is just the effect of inflation driving down what the value of that is from a comparative standpoint. But a lot of it is just that I just don't have enough time and enough bandwidth to let that many people into my practice. And a lot of it has to do with me getting older. My peer group is, getting wealthier. They're selling their businesses. I see a lot of deal flow from that. And I could open all the $1 million accounts that I wanted. I could open a couple a week for sure. I see a lot of people that want to come into our ecosystem, and I just have to modulate it. And so I had a little bit of a hard time just from a social standpoint of explaining to people what a minimum looks like. And so I've sort of begun to articulate it in a different way when people say, do you have a minimum? Well, no, I don't have a minimum investment because there's too many variables. Somebody who's 40 years old with $3 million is a much better client for me than a 90-year-old with a $3 million client, or the $3 million investment amount. And so I don't really want to draw a line in the sand and say, oh, the number's $3 million, because it's not just $3 million. And another way that I explain it is that out of respect for them, I kind of have to have a $25,000 minimum annual fee to make the system work for them. And so when somebody wants to present $1 million, then I say, well, you could be paying a 2.5% annual fee. There's just no way you're going to come out ahead with that type of system. So we really sort of see our $3 million clients as the one and higher who can benefit from what we do and relatively low cost methodology. So it's much more palatable to hear it as the recipient of that information rather than say, no, you don't have enough money. It's just the fact that I have economics that drive much of my decision making, and it probably doesn't make sense for either one of us. So, and my willingness to accept those clients would have bogged down my ability to serve that ultra high net worth client. So you just have to be very careful about what you let into your practice, or you will end up with what you allow. Yes. And if you only allow big clients into your practice, you will only have big clients.
Yes. They say you tend to get what you expect.
That's exactly right.
That's right. So having a minimum makes sense from the perspective of just trying to manage the business and manage people. And you can see how situationally an older person with the same amount of money as a younger person might not be as attractive to run. So there, many people run around and say, hey, we have this minimum and it's all kind of arrogant. We're a big deal. And it's really not about being a big deal. It's really about what's the right kind of clients for our practice. You're looking for the right people.
That's right. And I run my business in a very scalable manner. We have very simple investment methodologies, and we allow clients to name their own tune. We just don't allow them to select the notes. We play the notes. We choose the tempo. We choose the beat. We choose everything. We will play their song, but it has to be played with our notes. And we don't allow clients to choose their own securities. And nobody ever demands that. if a lot of advisors say, well, I want the account so bad, I'll let the client do what they want to do. You will never be able to scale a business like this if you allow clients to choose their own securities.
No way. Yeah, no way.
So we have very narrowly defined strategies that we force our clients into, and that's through years of experiment, decades of experimenting with other ways to do it. And so we run a large cap rising dividend individual equity strategy that's tax efficient, and we run an all ETF core satellite, and then we run an aggressive growth strategy, and then we have a muni bond overlay for clients who don't want full equity market participation. And the whole $1.3 billion pretty much is invested that way, with one exception. Our biggest position at the firm is Berkshire Hathaway. Our second biggest position at the firm is the Vanguard Total Stock Market Index Fund. So that's symbol VTI and VTSAX. We also have GIPS compliance with regard to our investing strategies, although we don't pursue institutional accounts. Ultra high net worth clients tend to understand what GIPS methodology is about. So it's kind of a mini institutional type of practice, ultra high net worth, very simple, easy to scale. Everybody owns the same securities. They just own them in different proportions. And so that's the key to rolling this type of business out at scale.
And then, Gil, you haven't used really any outside managers from networks like InvestNet or others. It's really more all your management.
We don't have any wrap account business at all. We were actually a manager on the InvestNet system, but I didn't want to hire a marketing team to pursue institutional accounts. So we kind of dropped out of the InvestNet system as a manager. But no, we don't use any third-party managers at all. We have less than 5% of our firm's money, client money at our firm, in mutual funds. We have probably 15 to 20% in ETFs, and the remainder is in individual securities. We tax manage our securities by individual tax lot. And so the ultra high net worth client understands how managing each position at the tax lot level can generate much better outcomes for them. And we also have charitable giving as a very large portion of what we counsel clients towards, and low basis securities are one of the better ways to accomplish that. So we are very deliberate about managing for unrealized gain. We have more than $500 million worth of unrealized gain on our books. That would not happen if we weren't deliberate about preserving unrealized gain for clients. An unrealized gain is 60% more valuable than a realized gain. And so we manage for unrealized gain, where typical broker methodology is managing for realized gain. The glory of short-term performance and trading, that really erodes compounded return. So we explain to clients how that works. And it also makes the business very sticky. Good luck transferring one of my accounts away when it's already got, $14 million in unrealized gain.
No, that's nice. That's a good way to protect the practice as well, but also working with all the philanthropy work and estate planning, you can also help manage those.
That's exactly right
as well.
Yeah,
that's right. Well, you also mentioned to me that you managed to start with a client at $100 million. You acquired a $100 million account.
I did.
How could that happen?
Well, I was already doing business with another family member, and then they referred a different family member into the mix. And so we've just continued to expand. How we have many families that we do business with 4 generations, and so that's how it happens. And so we get also very large referrals from CPAs and attorneys. They understand what it is that we're doing, and refer their clients to us. So
nice. Well, it sounds like a great practice. So, Gil, now that you built this all up, obviously everyone's looking to make sure that the legacy that you've created continues on with someone else, and you and I and others are looking for folks to eventually, succeed their practice and continue to grow it and serve the clients really well and the families really well. What could you help our group and explain? Were there any things that you kind of read or things that were pivotal in your background that led you to where you are now? Are there any thought leaders in the industry that said, this is how I want to be, and this is how you develop this business?
Well, as you mentioned, succession is my absolute biggest challenge.
Mm-hmm.
And the people that I've listened to the most that I think have been the most influential for me would probably be Warren Buffett. Although I would probably list him more as second or third on the list. I think that Jack Bogle is probably the most influential person in my life with regard to my understanding of how things work. And I also learned a lot through the School of Hard Knocks about chasing managers and chasing incremental performance. And the low hanging fruit is controlling the controllable. But like we said about taxes and fees, and Bogle was a leader in that. The invention of the index fund in the 1970s really laid the groundwork for much of what I do, and it laid the groundwork for an ecosystem that also ends up with clients perceiving that incremental performance comes from stock selection and other sexy methodologies, when in fact beta is what people are buying. They just don't understand it. Market deviation, market volatility, market returns being beta, that is what drives investment performance. It is not the fancy security selections and the bobbing and the weaving, which creates taxes and fees, which are friction points for the typical investor. If you're trying to get wealthy, you're going to expose yourself to market beta over the longest time period and in the most fee and tax efficient way. And so Bogle's methodology was right down the fairway of really what works best for investors. And we take it a step further because I don't believe that an index fund is the be all to end all. I believe that an index methodology, choosing individual securities, is actually the be all to end all, because the tax management that you can create with individual securities is so far superior to what you can do with an index fund. So yes, we have indexing at a core position within our portfolios, but we choose individual securities in order to get the real gusto from the tax management of the individual tax lots, which is much more powerful than the alpha I might have created, and which is so fleeting and so expensive to try to acquire and is not replicable over long market cycles. And so we just choose a different methodology as to how we want to pursue that.
You really honed your strategies, and a lot of it's through trial and error over decades and decades, isn't it?
Yeah, that's exactly right. So I had a lot of head slap moments along the way about, why am I chasing my tail here? I would have been so much better off to have done X and Y. And frankly, it's affected how I invest my own money. I take much bigger position. I'm 100% invested in equities in my own account. I buy a fixed amount of equities. I buy the segment rising dividend strategy every month in my own account. Every time the stock market drops by 5%, I double dip. So I buy two of those. I buy the dips. I buy every month. I'm still an accumulator. It helps me with my sanity with regard to how much vulnerability I've got to a market decline. If you take market declines and you just put them in one particular basket, that I'm a victim because the market is declining, it's much more helpful through some type of a dollar cost averaging methodology to understand that each market dip actually helps me in the end. And we get our clients to subscribe to that theory as well. So when the stock market starts to fall apart, we do not get panicked calls from clients. And so it's a much more relaxed way to manage your business and your life. And so I don't worry about the next market dip.
They're looking for an opportunity, which
That's
is great.
right. That's right.
So Gil,
the stocks go up in 81% of all circumstances. Why would I?
Right.
Why would I not be? If you're betting on that other 19% of the time, you're going to be the greater fool.
Yeah, no, you're right, and the managing emotions to keep people from freaking out in the 19% of the time is really a big part of our job.
That's exactly right. Which John Bogle also said, in the end, an advisor's primary role is to keep an investor in their seat.
Right,
and that's correct. That is their primary role.
Right, exactly. Well, good. Well, tell us, Gil, what else is on the horizon? What do you see happening in the industry going forward? any new initiatives you're thinking about for your practice, or anything the industry is looking at?
I'm in the process of writing a book, sort of getting the framework together for an industry book that talks about these issues. So it's sort of a practice management 101 book. So I don't know when I'll release that. It took me an awful long time to write the first one. So don't be checking Amazon for my second book.
Not for that one.
But yeah, so I think an industry book will be next. And, number one on my priority list in managing my own practice, yes, I want to continue to grow it. And I do prospect, and I have a business development person who works here. And yes, I do want to grow the business, but bringing in a successor or somebody who, in the business, rainmaking is the key to the whole thing. Investment methodology is a commodity as far as I'm concerned. And the ability to articulate what your value-added proposition is and be able to attract and retain clients is the key to success in this business, and keeping it simple and manageable and scalable. That's essentially those are the hallmarks that I stay focused on every day. But finding young talent that has the ability to come in behind me and replace me, man, that is just such a hard formula. And I do get calls all the time from people who are essentially wannabes. It's somebody 10 years in the business with a small book of business, hates to prospect, and is looking to jump 15 years forward into their career and come in behind me. That person, I just can't hire that person. I got to have the guy who's 42 years old and 8 years in the business and has a $200 million book of business, and he or she probably knows what they're doing. And so that's the kind of person that I'm looking for. So if you know anybody, send them my way. But anyhow, that's the number one priority on my list right now.
Great. Well, this will go out over the whole Financial Advisors Workshop Network, so maybe we will find somebody, Gil.
Yeah, you never know.
Never know. Well, great. Well, you've really you're an icon in the industry, and you've written some great, one and soon to be two great books. And it's really a pleasure to talk with you, to see how you develop this, and to hear how it's supposed to be done.
Yeah. Well, thank you very much. I really appreciate that.
Really an honor, and thanks for being with us today in the Financial Advisors Workshop. Maybe we can do a follow up with you in 6 months, a year, see how that succession's going, and see if there's any other new insights you'll have for us, Gil.
Very good. Thank you.
Excellent. Thanks again. And thanks everybody for being with us today on the Financial Advisors Workshop. Our guest today, Gil Baumgartner from Houston, Texas. What a great discussion. Thanks so much.
Appreciate it.
Okay. Take care.